Wow, the precious metals market has just been on an absolutely wild ride. We've seen prices swing so dramatically, it has investors and analysts, well, everyone, scrambling for answers. So, what we've just seen is nothing short of a historic market event, a massive, shocking sell off, followed by a stunningly fast recovery, all in the span of just a few days. The big question on everyone's mind is what's really driving this crazy volatility? And where are gold and silver headed from here? First, let's just take a second to really get a handle on the sheer scale of this market whiplash. The numbers behind this rebound are, frankly, staggering. Get this. On one single day, silver prices collapsed by 30%. Now, this wasn't just a bad day. This was the metal's worst one-day performance since 1980, a truly historic drop. But then, almost immediately, the market just snapped right back. Silver's spot price jumped nearly 6% just a couple of days later. This wasn't some slow, gradual recovery. It was a violent V-shape that perfectly illustrates the extreme volatility we're talking about. And make no mistake, this wasn't just a story about silver. Gold, the traditional heavyweight of precious metals, got caught in the exact same storm. It plunged almost 10% before staging its own powerful comeback, which tells you right away this was a huge market-wide event. So you have to ask, why did this happen? What powerful forces could possibly reverse such a massive sell-off almost overnight? Well, to answer that, analysts are pointing to a confluence of factors that all seem to hit at the exact same time, creating this kind of perfect storm for a rebound. It really boils down to four key things coming together. First, you had opportunistic dip buyers jumping in, basically seeing that huge crash as a bargain they just couldn't pass up. Second, the US dollar got a little weaker, and because gold is priced in dollars, a weaker dollar makes it cheaper for foreign investors, which can really fuel buying. Third, the broader stock market started to stabilize, which calmed some nerves. And finally, with all the chaos, investors just started looking for a safe haven, a place to protect their cash. This quote here from ING strategist Eva Monthe really nails that dip buying idea. She directly links the rebound to investors rushing in after one of the sharpest drops we've seen in years. It's a classic market reaction, right? When something valuable falls that fast, a lot of people see a buying opportunity. And to add another layer to this, we've got the CEO of UBS, Sergio Ermotti, pointing out a real shift in attitude. He says his clients are actively looking for protection. They're literally moving money out of hot sectors like tech and into things that are seen as safe havens like precious metals. So this wasn't just bargain hunting, it was a real flight to safety. Okay, so that helps explain the rebound. But what about the future? Is the storm over? Well, according to analysts, not by a long shot. The consensus view is that while the immediate crisis might have passed, the underlying reasons that caused it haven't just disappeared. So, yeah, we should probably buckle up for some more turbulence. Analysts are calling this a positioning-driven reset, which is really just a fancy way of saying it was a rapid shakeout of nervous investors, not some fundamental change in the long-term upward trend for metals. So, what should we be watching? Well, experts say to keep a close eye on four main things: the direction of the US dollar, any signals from the Federal Reserve about interest rates, the overall market mood or risk sentiment, which is basically how willing investors are to take chances, and crucially, any political uncertainty brewing in the US. Now, with all this uncertainty swirling around, it's probably no surprise that the experts at the big banks are pretty much all over the place on where gold goes from here. And you can really see that division right here. On one side, you have Goldman Sachs targeting $5,400 by the end of 2026. They're betting that central banks will keep buying up gold and that more investors will pile into ETFs. Those are exchange-traded funds that track the price of gold. But then, on the other hand, both the securities is way more bullish in the short term. They're calling for a $6,000 target in the coming months, citing supportive fundamentals. So what's the deal? Why can't these top analysts agree? Well, it really just boils down to a few major unknown variables that are clouding everyone's crystal ball right now. Bank of America specifically points to these things. You've got the upcoming midterm elections creating this political fog. Then, the nomination of Kevin Warsh as a potential new Fed chair, that's a huge wild card for interest rate policy. And honestly, the sheer speed and volatility of the recent price swings have just made everyone a little nervous about making a firm prediction. So, when you boil it all down, what you have is a market being pulled in two different directions at the same time. You've got these really strong fundamental reasons to buy, like that search for safety, but you also have this massive uncertainty and volatility that could easily spark another sharp correction. It's a real crossroads. And that leaves us with the ultimate question. In a market this divided and this volatile, are we looking at a golden opportunity? Or is this whole thing just a trap waiting to spring on unsuspecting investors? That's the billion-dollar question everyone in this market is trying to answer right now.